Remember in previous videos, we identified what we like to call the trinity of market behavior, where depending on the time horizon of the trading or investment strategy, we have identified three zones. The microstructure zone for strategies having very short time periods, so going from milliseconds to minutes. Then the trader's battleground zone for strategies going from minutes to weeks. And finally, the strategic investment zone for strategies going from weeks to decades. Remember also that we said for strategies within the green area, so the strategic investment zone, that those were primarily facing a noise in the high frequency bandwidth, while strategies having very short-term time horizons are primarily disturbed by low frequency noise. As a quick reference, here are the two YouTube videos you can refer to if you want to learn a little bit more about how we define market noise and also about the table we just presented. Now, in our case, we are primarily focused on long-term strategies, so our scope is the strategic investment zone. And within that zone, what is then the problem space for today's video? Well, it is related to the fact that raw price data often contains high frequency noise. So in our case, we are only focused on the high frequency noise. And this noise comes along with three, let's say, problems. The first one is that it masks important market patterns. The second is that it introduces spurious fluctuations into market indicators. And finally, this noise blurs the structural market shifts, which can become difficult for us to detect reliably. Welcome to Alpha Quant Solutions, the platform where markets meet science and engineering to deliver your investment edge. Now, the traditional answers to this problem space rely on the use of classical filtering and indicators from technical analysis. And we have primarily these two, so the simple moving average, the SMA, and the exponential moving average. And both of them are so-called causal filters. And a causal filter is basically a filter whose output at any time t depends only on present and past inputs and never on future inputs. Quick disclaimers. We do not give investment or financial advice. We are only sharing our personal opinions. We first focus on the simple moving average, or SMA. Well, this one has two benefits and let's say three liabilities. So what are the good points of SMAs? Well, these SMAs are one of the most basic filtering techniques, so it's quite simple, and it computes the average of the last n data points, treating each point with equal weight. The second good point about SMAs is that the filter is causal. So as we just mentioned before, it relies only on past data, making it suitable for real-time systems. Now, the three main drawbacks of an SMA filter were first, the SMA introduces lag. Since all n values are equally weighted, it responds slowly to abrupt changes or trend reversals. So this is well known. The second point is that from a signal processing perspective, the SMA has poor frequency discrimination. So what we can say further about that is while it does suppress some high frequency noise, its broad and gradual frequency response leads to leakage from undesired frequencies and hence limiting its effectiveness in clean trend extraction. Finally, the third and last drawback about SMA, which is quite substantial, is that it lacks nuance in distinguishing between random fluctuations and structural shifts in the price signal. Moving now to the exponential moving average, also known as EMA, we list here three advantages and three drawbacks. So in terms of advantages, the EMA improves on the SMA by assigning exponentially decreasing weights to all the prices, and hence this gives more emphasis to recent data, making the filter more responsive to trend changes. So this is well known. And this translates into a key advantage, which is its faster reaction time. Hence, it is more adaptive in terms of being a low-pass filter than the SMA, and it is better at capturing trend shifts at an early stage. Now, and what is also what do they have in common? The SMA and the EMA is that they are both causal filters, and they are hence both compatible for real-time applications. Moving now to the three main liabilities of the EMA. The first one is also a very well-known one, is that the EMA still does introduce some lag, even if that lag is lower or less than what an equivalent SMA might introduce. The second is that the EMA lacks a sharply defined frequency cutoff. And finally, the EMA has a greater sensitivity to short-term volatility and noise. And this is really a major point when we want to use the EMA for trading and investing decisions. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Here is a first illustration of some of the shortcomings of these traditional filters. In this case, we show an example where the filter is unable to separate random fluctuations from a structural market shift. And we have used here as an illustration, as an example, the S&P 500 between 2019 and June 2025. We are using daily close prices, and this is a view from our dashboard. So in light cyan color or light blue color, you have the original unfiltered raw price, and in white, the SMA 200. And you can see here, this is the COVID pandemic period. This is the first quarter of 2025 with the tariff shock, that in both cases, the SMA 200 is unable to pick up the crash and the subsequent recovery. Next, we illustrate here the introduction of the time lag by these traditional filters. So this holds for both the SMA and EMA, although this time lag is way more pronounced in general when we use SMA filters. And here is an example. Again, we use the S&P 500, this time between 2021 and the end of 2023. The original unfiltered raw price data showing daily close action is shown in cyan color. The corresponding SMA 200 filter is shown in white. And in this chart, we can see that there is a time lag when we look at the market top between here, the unfiltered and the filtered price around here, but also when the market bottoms, in this case between here and approximately there for the filtered version. And in both cases, we can see it's about approximately 3 to 4 months time lag. Now, in the next videos, we will show how we can replace these SMAs and EMA filtering techniques by more advanced ones. And what we will do, we will build a robust preprocessing pipeline that will allow us to do two things. First, to amplify the signal-to-noise ratio of financial time series. And second, and just as important, is to allow for a real-time use case of these methods. And all of this basically will deliver a transformative use or transformative filtering techniques that we can apply across a wide range of downstream applications. Thank you for watching, and until next time.